Hello, everyone. Thanks for joining us today. Today, we have a speaker whom most of you would probably know or have taken a class with. Today's speaker is Professor Aaron Anderson. First of all, I would like to thank Professor Anderson for taking out time from his busy schedule. Professor Anderson holds an MBA from Harvard Business School. He was the director of business initiatives for Mayor Johnson's office in Sacramento from 2013 to 2015, after which he joined as principal at Impact Venture Capital, where he has been a part of funding numerous startups. He's also a lecturer at UC Davis, teaching the Engineering 8 class, which I believe many of us have taken, and is also the director of the Student Startup Center. So, without further ado, let's get into today's interesting session.
Awesome. It's a pleasure to be here, Shivya. I appreciate it. And yeah, I do recognize a lot of names on the screen. I wish I could recognize faces on the screen, but no one's got their cameras on. So do me a solid and fix that problem. But yeah, thank you for having me. It's an honor to be here, but also slightly humiliating to hear your biography read back to you like that. So thank you for doing it. But my goodness, it makes me sound like my father.
But well, you have achieved numerous things, some things which many people have not been able to.
No, thank you. It's kind of you to say. Yeah, thanks.
So, first we'll go over with questions from the board members, followed by the audience questions. All of you will get a chance to ask your questions. First of all, the first question that we have is, how did you get started in the world of funding? And what
Yeah.
exactly are the types of funding entrepreneurs can receive?
Yeah. So, oh boy. So the two meaty questions. I want to be careful. I know a lot of you have heard my story before, but not everyone. It's I got in the world of venture capital accidentally. I'd be lying if I said it was deliberate. In fact, early in my career, I was kind of avoiding it. So, by background, I was an economic developer. What that meant was is that I was really keen on helping solve poverty. I wanted to find solutions to the problem of people not being able to find great jobs, not being able to live their fullest lives. And I was particularly curious about economic development as it applied to developing countries. So in pursuit of that interest, I kind of hit every industry sector you possibly could before I got into the world of entrepreneurship. I spent some time in the federal government working for the State Department. After I graduated from my undergraduate institution at Brigham Young University, I went and I got married and then moved to Africa to try my hand in the nonprofit world. Spent a few years working for Habitat for Humanity out there, but was always frustrated because I felt like my work wasn't having the impact I wanted it to have. I mean, I look back now and realize, well, that's just because I had an entry-level position and I was kind of dumb. I didn't know what I was doing. But at the time, it was like, what are we doing wrong? I needed to learn something new. And I'm glad that I was frustrated in that regard because it got me to where I am today. So a few of you have heard me share it before, but I remember one very specific afternoon just at my wit's end, wondering why our nonprofit efforts weren't having the impact we wanted them to have. When I was frustrated like that, I got really good at complaining. And my wife, my new bride at the time, was really good at understanding what to do to get me to quit complaining. And that was to take me to the local McDonald's and get me an ice cream cone because they were like 40 cents. We could afford it and they tasted good. And so she took me to McDonald's, was enjoying my ice cream cone. I remember distinctly, and again, a few of you have heard me say this before, but I remember distinctly looking into the kitchen of that McDonald's and realizing, there were like a dozen college students working there. They were all attending the local university in South Africa. They were from across the continent. And it was that moment that I realized that McDonald's was doing more to promote economic development in Africa than I was. And that's never a good feeling when McDonald's is better for the world than you are. Like that's, kind of sucks. But it was also the moment I realized if I really wanted to get good at economic development, I needed to learn how businesses worked. And that's how I ended up getting my MBA, got me into Harvard. was very lucky. So, Shavia, you mentioned, this great, bullet on my resume. I want to be emphatic that a lot of what has happened in my life was good fortune and the help of others. Not, I would be dishonest if I took credit for it myself. But yeah, I got lucky. I learned the kind of the world of business generally, and trying to decide whether I was going to abandon this economic development career or not. I got a phone call from the mayor of Sacramento, inviting me to be his director of business initiative. Felt right up my alley, and it was a chance for me to come home. I grew up in Davis. And that job ended up becoming one where I spent all my time not trying to lure businesses to Sacramento, but trying to convince founders to launch startups in Sacramento. And so when I say I stumbled into the world of venture capital, that was it. Like, that's how I got involved in the world of startups, trying to help them launch. And it was like this natural jump from working with them to figuring out how to invest in them. So that is my entry point into the startup world. Now, you had a second question about the different types of funding startups can receive. Is that right?
Yep, that's right.
Yeah. So that's a whole nother question. So I think the important thing that I would highlight first and foremost about the funding sources available is that they very much depend on what type of company you want to run. So many folks are interested in entrepreneurship because they want to run, like, they want their own small business, whether that's like a restaurant or a nail salon, or like, I don't know, like you want to be a personal trainer. And if that is your cup of tea, then there aren't a lot of funding sources that are, unique. Like, there is the small business loan, but usually you need to like have some years of capital and something to prove that you're an operating business. There is like Go Save, have a day job and save your money so that you can invest in yourself. Maybe some friends and family believe in what you're doing and are willing to help you out, but there aren't like a lot of sources of capital. On the other hand, if your ambition is to be a tech entrepreneur, then there are new opportunities. And that's the world of venture capital. So venture capital is all about investing big dollars into tech companies with the ambition that those companies that are small today will someday be enormous. And unlike a bank loan that you have to pay back, you never have to pay back venture capital investment, but they do come with strings attached. And the expectation is, well, not the reality is that these investors own some fraction of your company. That fraction of your company will be worth a whole lot more in the future someday. And then when they sell it, the idea is that, well, that's how you make all of your money. So venture capital as an asset class where you invest in startups is very real. And there are a lot of different types of investors that we can talk about and different stages of investment. But they are only available to entrepreneurs who have, I don't want to use the word ambition because it implies that small business owners aren't ambitious, and that's not true at all, but only have the vision of becoming, the next Google. Like, you want to run $1 billion company. And that is not for everybody, nor should it be, but that's what venture capital is reserved for. So kind of high level, those are some of the opportunities that you have as a startup. And we can get into any of the specifically if there are specific questions about them.
That's true. Our next question is, what is the biggest mistake entrepreneurs make with regard to money? In your experience?
So entrepreneurs make a ton of mistakes. And I mean, investors do too. Startups is it's a world of mistakes. So my opinion of entrepreneurship and kind of my understanding of entrepreneurship is that when you are launching a company, what you're really doing is launching a science experiment. And you have all these hypotheses on day one, but you have to go prove that they're real. Like, you have to prove that what you think is real, actually is. And just like any other science experiment, like, a lot of your hypotheses are going to be wrong. And so you can call those mistakes, Shavia, that, like, you know what, this is not something customers are willing to pay for, or this was not the right way to charge them, or this was not the right amount to charge them. And I guess those are mistakes when it turns out you weren't right. But the reality is there's no way to know ahead of time what is real, what is the truth. You just have to figure it out. You learn by doing. So if you count those as mistakes, well, my goodness, entrepreneurs make those mistakes, multiple times a day. I think maybe though the spirit of your question here is more about like, what are the dumb things entrepreneurs do that they could avoid? And there are a handful of those as well. From my perspective as an investor, the big mistakes I see are the ones that entrepreneurs make when they're trying to secure investment. And there are a lot of things that you could avoid that could really help your company out. So, for example, almost all venture capital firms, they specialize. They don't just invest in any old startup, they invest in a certain kind of startup. So sometimes they specialize by geography, like I only invest in startups from the Seattle area. Sometimes they invest in stage. I only invest in startups that have more than $1 million in revenue, but less than 5. Or I only invest in startups with more than 50 million in revenue. Or I only invest in startups with no revenue, like very early. And so, that's one way they do it. The most common way investors divide themselves is by industry. I'm a pharma investor or a biotech investor, or I only do software, or I only do hardware. And I see a lot of entrepreneurs make the mistake of trying to pitch to investors, trying to get in front of investors that don't match the stage, geography, or industry of their company. And this is bad for a few reasons. Like, one, it's bad, because you're just wasting a whole lot of time. When you're founding a company, you don't have a lot of time and money. You don't want to spend any of it on things that aren't productive, and you will never, ever get anywhere with investors that don't match, whose thesis doesn't match what you're trying to do. More problematic, though, is that word gets out that you don't know what you're doing. You haven't done your homework. You're not a smart entrepreneur, and kind of once you have that reputation, it's almost impossible to get investment. So you need to make sure you do your homework if you're going out for investment. Kind of tied to that, another big mistake entrepreneurs make as it relates to investment is that they go after investors too early. You really don't want to be in a situation where you're pitching to an investor before you have real traction you can point to. This usually means that you have kind of first revenues. Sometimes it means that you have a really cool technology that, you've built the proof of concept and it's working, or at least that you have some kind of relationships you can point to that give the credible reason to believe that you will progress. As much as we like to think of the startup world as kind of like the Wild West, anything goes, investors are risk averse. And so, knowing that they invest in venture capital means that they have a better risk tolerance than other types of investors. But all things being equal, you want to invest in the company that's most likely to be successful. And traction is the best way I know of to prove to the world that you aren't as risky as all the other options. So one piece of advice I got early on that I think makes a lot of sense if you're a startup founder is, if you're looking for money, ask for advice. And if you're looking for advice, ask for money. Anytime you explicitly ask for dollars, investors hem and haw. But when you're asking for advice and showing all the cool things you're doing, you just might get somebody really excited. And so that kind of gets to my other big point, I would say, that about mistakes entrepreneurs make, at least in the fundraising process, is that they fail to understand just how networked a business it is. Every day I get notes on LinkedIn and emails from folks I have never met, never heard of, don't know who they are. And the reality is I get too many of them to ever begin to spend all of my time kind of sifting through them and deciding which ones are my favorite. And so the startups that get introduced to me warmly, like somebody I know introduced me to the startup, or, we have a mutual friend, or at least like a mutual interest somewhere, they're just so much more likely to make it to the top of the pile. And so I absolutely recommend to every one of you that you invest a lot of time and energy into building your network now, long before you will ever need to lean in on it. So, in the spirit of asking for, or finding advice, like, if you find someone on LinkedIn or on Twitter that's doing something you find cool, like find a way to connect with, go to events, meet people, meet faculty that are doing really cool research that you want to learn more about. Go to investor events that are open to the public, go check out the demo days and like just start meeting people. You will never know how many doors can be opened to you by people you didn't know before until you start trying. And I'm kind of, I'm a hypocrite here. Like I always consider myself something of an introvert. I hated going to those like wine and cheese schmooze parties when you're trying to get a job. But the reality is, if you can get to know these people somehow, they can open doors for you. You want to get to the point in your life where you never have to apply for a job again. Like your network helps you find it, and hopefully, for a lot of you being entrepreneurs, maybe you're the one creating that job as well. But those are big mistakes I see entrepreneurs make all of the time. And investors who see so many founders every single day, like can quickly differentiate between the startup founders who know what they're doing and the ones who are trying to figure it out. And my advice is like, obviously go figure it out. Everyone needs to do that somehow. Just try not to do that in the offices of an investor. Better to make your mistakes before you meet with them.
I definitely agree. Networking is really important. Next question is going on off of this question, that like you said that we should have a plan or traction or something like that before we go to an investor. But like in times like this, which are unpredictable, why do investors look for a plan? Because the plan will not be followed in such unpredictable times.
Yeah. So once upon a time, venture investors did expect detailed and thorough business plans. Every entrepreneur would come in with like a document this thick of everything they're going to do, and they'd hand it over to the investor, and the investor would put it in the pile, and nobody ever read it. Did no good except to kill a lot of trees. That's like I don't see that anymore. That doesn't happen. I usually get a 12-slide pitch deck when I'm meeting an entrepreneur for the first time. I'm always excited when I get a video instead. Some professional video tell me their story. Because you're right, like especially for seed stage investors like myself who invest very early in companies. Like the one thing I have the most confidence in is that if this company is successful, it's not going to look anything like what they're pitching today. Like there will be a pivot somewhere. It will evolve before they really figure out kind of the product market fit and where they need to be. So to that end, though, there are some things that I think are critical that I want to understand and that I want to hear you speak to, even if you don't get it exactly right. So the very first thing that I think is most important is the problem that you are solving. You'd be surprised, I think, how many entrepreneurs like fail to articulate exactly why it is that they exist in the first place. So, you need to have a real problem, and I need to believe that people want it solved, that they'll pay to have a solution to this problem. So the problem needs to be real. The second thing I really look for is clarity around just how big the problem is. Another way to put that is your market size. So because I'm a venture investor, I only invest in companies that have the potential to get really, really big in the future. I do that for a few reasons. Number one reason is because most of my investments are going to go belly up, and I need a really big home run to kind of cover all my losses. I'm building a portfolio of companies with my fund, and any given one of them big enough to kind of cover all the losses. That's how venture capital works. So I care about market size. You could be solving a really, really important problem, but if only 5 people in the world have that problem and they're only willing to pay $100 to have it solved, like that's just not a big enough market to really be attractive. So the market size is the next big thing I look for, kind of tied to the problem. But it's not just how big the market is. I also care a lot about the trajectory of the market. So what I want to do is hop on an industry that hasn't taken off yet, but is about to. Uber is a great example. Like ride hailing and ride sharing didn't exist as an industry when Uber started, or if it did, it was like, very, very small. But Uber created this market that is now enormous. And if I invest in Uber in its early days, well, I'd be a billionaire right now because the market took off. The next thing I care a whole lot about is the team. So I need to believe in the competence of the team. I need to believe that they are committed to solving this problem, that they have the grit to get through like the really dark days, because entrepreneurship is super hard and there will be dark days. I need to believe that they're smart enough to build the technology they say they're going to build, and smart enough to know how and when to pivot. You know, if I don't believe in those things, if you seem half-hearted about what you're doing, I'm not going to invest in you. And then the last thing I really dive into is the technology. And really what I mean by that is the secret sauce behind the company. I am really excited when a startup has some kind of unfair advantage where its competitors are going to struggle against it. You know, whether that is the technology itself or some kind of, you know, relationships they have and industry expertise that is very rare, some kind of insight that the rest of the world doesn't see. I want them to have an advantage over their competitors. Because what really sucks is when you invest in a great team and a great market, but they just didn't execute as well as the other team trying to do the same thing. That's, you know, you don't want to invest in MySpace, you want to invest in Facebook, right? So those are kind of the things I look for. So Xavier, to your question, like we're not looking for like big detailed business plans anymore. Those aren't useful. That's like fan fiction, you know, it's just something somebody wrote and it's not real. But I am looking for, in a pitch, kind of hitting these key points, you know, having credible and plausible answers to those questions. And then when I see that in the deck or your first pitch, well, then I start taking other meetings and doing my real due diligence on a company.
So basically the lean startup model.
Sure, absolutely.
And one last question is that what would your advice be for young entrepreneurs?
For young entrepreneurs, I mean, so honestly, I everything I just said, I hope you like internalize and take away as something to consider, especially the bit about the network. The only thing that I think is critical advice for young entrepreneurs to learn that we haven't talked about already is just how important it is to be aware of big problems. So one of the big challenges we have with student teams here at UC Davis right now is, I mean, it's the challenge every university has, and that is that you're all young, you know, 18, 19, 20 some odd years old, and you don't have a lot of experience in the professional world. That experience or that lack of experience, it's problematic in that you might not have all the skills you need to launch a company. But the reality is, like, if I'm honest with myself, I don't have that many skills either. I'm just older. So like getting skills is obviously a really good thing. All things being equal, I want somebody with more professional skills than not. Those could be technical, those could be social skills, and what do they call it? Emotional intelligence and all of that stuff. But where it's really a challenge to have a lack of experience, I think, is less to do with the skill set and a lot more to do with the awareness of problems that are worthy to solve. So every year I get, 4 or 5 students that pitch to me this idea of building a startup for I don't know, bike safety, because that's what you see at UC Davis. My bike was stolen last month. It irritated me. I'm going to solve this problem. Or like study habits. I took, Chem 101 and it was really, really hard and I really needed a study buddy. And the reason I see those types of startups on campus often is because those are the problems that students experience. But the problem with those problems as the backbone for a startup is that, well, one, lots of people are trying to build similar solutions because there are a lot of students that have those problems. But 2, they generally aren't big enough. Like, there aren't enough people in the United States riding bikes for bike safety and security to be like the next billion-dollar startup. But, if you've gone and worked with semiconductors for a decade, you're going to be aware of all sorts of interesting problems that I just don't know anything about. And so to your question about advice, in addition to everything we talked about before, my advice is like find every way you can to get out into the world and be aware of problems that bother people every day. Whether that's, problems your mom has at home, problems your dad has at home, problems your boss has at work, problems within your industry that you want to learn about, problems your professor has doing her research, like whatever it might be. Be keenly aware of problems out there that people, would be excited to have solved. Write it down every time you see something. Because if you are really smart about the problem you're trying to solve, you're going to be more successful building a company around it.
That's very true. I think the audience are now eager to ask you questions. We
Yeah,
have
let's do it.
a question already.
Hi, Prof.
Sorry,
Hi.
Okay, you can go ahead.
Yeah, sure. Hi, Professor. This is Sadid. It was nice listening to you talk. I have a few questions. So the first question is, how are famous venture capital firms like Sequoia, seed money accelerators like Y Combinator so successful in identifying and investing in startups that go on to become billion-dollar unicorns? So, like, should a startup founder aspire to receive funding from these venture capitalists? Should it be a top priority for them, where once he gets funding from these top VC firms, all the other does it act like a puller, where once he gets funding from this particular firms, all the other VC firms are in line to get the funding to put the funding?
Yeah. So the question here is like, why are these top VC firms so successful, and how important is it for an entrepreneur to go after them?
Yeah.
So the simplest answer I can give to that question is that these top VC firms are so successful because, one, they have very strong networks, and two, they have really strong reputations. And so the best of the best go there. And so they act like a magnet for the very best entrepreneurs. And candidly, it's very easy to pick. Well, I shouldn't say very easy. It's much easier to pick the winners when you see the best all of the time. And so that's a huge advantage these firms have. One, the rest of the world envies. So I think that's the simple answer to your question. The best companies get referred to them, and the best companies want to be with them. And therefore, they kind of have the pick of the litter in terms of investment. Now, as for the entrepreneur, like, should I prioritize going after those firms? Well, absolutely, you should give it a try. But I want to be really clear that, there's a couple of important caveats. One, not every great company that those firms invest in not every company those firms invest in is going to turn out to be great. So it's not like a free ticket, a free pass to success. And on the other hand, like, they have limited numbers of companies they can invest in at any given time. So therefore, there's no way for them to invest in all of the successes. So you don't need to be in those firms to be successful. Plenty of examples of companies that weren't. Oftentimes, those firms put most of their capital in later stage startups as well. So like, if you're a seed company, it might be a little harder to get funding from those firms as opposed to like if you're in a growth round. And then the other thing I would say is, like, the industry you're focused on may necessitate you going after a different type of venture firm. Like, that's especially true if you're like, I don't know, biotech, wet sciences, like not a software play. You absolutely want to match like the kind of technology you're building and the industry you're chasing with the type of investment the firm invests in. So you don't want to be mismatched. But yeah, I mean, these firms, like, yeah, they're wildly successful, probably always will be, because their reputation is so strong, their network is so strong that they see the best all of the time.
Yeah. So another question which I had was, in VC startups, the VC partners not only act as a capital source, but also as an advisor. So how much control should VC partners have over the startup, and how should a situation be handled if a founder's vision diverges from a VC partner's vision?
Yeah, great question. So I'll start by saying this. Like, if your venture capital firm, your venture capital partner offers nothing to you except money, it's probably a bad idea to accept the cash. Like that's not a very good investor. You want an investor who is a partner, who can help you build your company, who can introduce you to customers and clients and other investors. You want a venture investor that can open doors for you. Not to beat a dead horse here, but your venture investors should be like this catalytic force in building your network so that you can grow your company. They need to be good at more than just writing checks. Now, the second question was about control. So as kind of like a general rule, each venture round will gobble up about 20 to 30% of the equity of a company. So if I go out for a seed round and I raise $1 million, that $1 million will probably buy 20 or 30% of my company. If I go for a growth round and raise $50 million, same thing, kind of a loosey-goosey rule here, but about 20 to 30% of your company. That's pretty standard and also pretty fair. Most venture firms don't want controlling interests in the startups they invest in. They want the founders to run it, and they want the founders to be incentivized to continue to run it. But they also need to get enough of the company for this to pencil out. Now, that said, when I say 20 to 30%, I'm talking about the whole round. And oftentimes 2 or 3 venture firms, or sometimes even more, will participate in that round. So any one venture firm might not own 20 to 30% of your company, but together the syndicate of investors will own 20 to 30% of your company. And they will often take board seats and have, some significant amount of control over what your company does. I would say, when it comes to disagreements, the best founders, in my experience, have been humble enough to know that they are not always the smartest person in the room, and often are not the smartest person in the room, and are very good at taking in advice and learning from people who have kind of been there, done that. But they also recognize that they are the ones in the trenches doing this day to day to day, and the investors are not. Like, they don't have the same level of information, passion, or interest. And frankly, they often contradict each other in the advice they give. So your job is to humbly process the advice and direction you're given, and kind of adopt, amend, or ignore what makes the most sense to what you're doing. But user beware. Like, if you screw it up, you can get fired, and rightfully so. Like, this isn't just your company anymore. The investors own a significant portion of it, and they have a financial incentive to see it success. In fact, they have a legal responsibility, a fiduciary responsibility, to make sure that they do whatever they can to maximize the success of the company. So the last thing in the world you want, though, is an embittered, embattled relationship with your investors. That would be hugely problematic, and usually only happens when things are really stressful.
Hemming is curious. What do you think is the optimal age for an entrepreneur?
So I don't have a good answer to that question. Young entrepreneurs have passion, and they have energy, and they have time, and they also don't have the same level of commitments. Older entrepreneurs have mortgages and families and can't be bothered with working at midnight. But they also have experience and network that young entrepreneurs don't have. Usually, the harder the science, the older the founder, but not always. I don't think there's a great answer to that question. I remember being told once, and I didn't validate this, so huge grain of salt, that on average, older entrepreneurs perform better than younger ones. But there's enough caveats and things to consider to make that not very good advice to make a life decision based on. So I think my way of dodging that question, Shavy, is just say, know what you're good at and surround yourself with people that are good at the things you're not good at, and then you're more likely to be successful.
Leonardo, you can unmute yourself and ask the question.
Yes, so Professor Anderson, I would like to ask 3 questions. First is, why investors invite themselves into the industry? The second one is, how do you ask investors for advice to ask for money? And third is, how do startups go through Series A, B, and C funding and then towards IPO?
Yeah, okay. So Leonardo, can you ask the first question again? I didn't catch the first one.
So the first question is, why investors divide themselves into different industries?
What investors invite themselves into different industries?
Yeah.
So I'm not sure. I'm not sure I understand that question. Have a very good answer for it, but let me dive into the others first, and maybe we'll get an answer to the question you're looking for. So, so your second question is like how to ask for advice in the first place. Well, so the bad news is it's hard. Like investors are busy people and they don't want to be bothered with things that aren't helpful to them. The good news is they're human. They have egos. They like to hear themselves talk on, Zoom conference calls, for example, and they're often publicly available. So, I don't think it would be hard to do like a Google search or an Eventbrite search and find events where investors are speaking and like get to them, be out there and meet people. You can try shooting a message on LinkedIn or Twitter or wherever, like let them know what you're up to. Like, let me share this. I was curious, wanted to ask your advice. I mean, that's not going to be super successful, but every now and then, you get lucky. One great way to get into investors is through their portfolio companies. So, if you can find a way to get connected with some of the founders of companies they've invested in and talk to those individuals first, they are often great introduction sources to investors. If I've invested in a portfolio company that's doing really, really well, and that founder wants to introduce me to somebody else, I'm going to take that meeting every time. So that's a clever way to do it. Honestly, Leonardo, though, like there's not a single great answer. It's like being scrappy and being creative, getting yourself in front of people, being where investors are, asking questions and asking for favors. The thing I would say is like the worst that can happen when you ask for a favor is that they say no and you're right back where you started from. But if you can impress them, like, maybe you get really lucky. I am not above like getting on LinkedIn and figuring out what mutual connections do I have with certain people and then asking for intros. I do that all of the time. It often fails and sometimes it works. So you just got to be creative. Like you got to find some connection somewhere, somehow to these individuals. Maybe they are alums of UC Davis and you can like play that card up. One thing I've seen a lot of successful student entrepreneurs do is they introduce themselves as students working on a student project looking for advice and conveniently fail to mention early on that it's also a startup that will someday need investment. When the email comes from your @ucdavis.edu email address, it's more likely to get responded to than if it came from your Gmail email address, for example. So yeah, you got to be clever, and what works for one person won't. You keep trying all sorts of things, but that's where scrappy and grit come in. And then you also asked about the difference between A, B, and growth rounds. Is that right?
I ask like how startups go through Series A, B, and C funding and how they eventually go towards IPO.
Yeah. So, I mean, to be candid, IPOs just don't happen that much anymore. I think it's like 90% of startup exits are mergers and acquisitions, not IPOs, because they are a lot easier. They're cleaner, simpler, less messy, less expensive. But I mean, kind of at the high level, any given round isn't radically different from another. You pitch your startup to a whole lot of investors. Most of them say no. Excited, they do the due diligence. They ask a bunch of questions, kind of poke your company with a stick and see if they like it. And then if they do, they write, you start negotiating terms on a deal. They give you a term sheet. If you both sign it, you get the lawyers involved and then you close a round. The big differences between any given round, I mean, a couple things. One, the dollar amounts. So a seed round is often like a couple $1 million investment. An A round is usually, I don't know, maybe 5 to 10. And you see growth rounds sometimes with like pushing $1 billion. So that's one big difference, is the amount of money involved. And so, but the most consequential difference, I would say, is like the metrics that investors are interested in. So if I'm a seed investor, I'm really interested in your initial traction and your first revenues. I'm interested in your technology, your team history. Now, when I start getting into an A round, well, then you need to have like, steady recurring revenue, more robust financial projections. I start caring about things like customer acquisition cost and lifetime value of customer. And some of these, like, you just Google startup metrics and you'll get a whole list. I know Andreessen Horowitz has a bunch of articles about like key startup metrics that they look at for that kind of stage of company. And then when you get into the growth rounds, I mean, you're practically a public company at that point. You might have hundreds of employees and, global workforce. And so like the data you get as you diligence those companies is much more reliable and, much more like, well, I guess just reliable, like you can trust it. And so, the further along a company gets, the more important like the regular old numbers are. Early on, it's like vision and trust. And so that's like kind of the big difference. The dollar amounts invested, and then like the key metrics that the investor cares about. And then the IPO process, that's a whole other nightmare that I don't have a lot of experience with. I've only been around companies that have exited by M&A, and I don't mind that. And it's easy for us that way. But that's like a whole class at the graduate school management you'll need to take about the IPO process, road shows, SEC filings, and all of that gnarly stuff. But it would be fun to go ring the bell at NASDAQ or the stock exchange or whatever and get your picture in the newspaper.
Sarah had a question. Did you ever try to create your own startup? And if so,
Oh, no, no. I am definitely an investor, and I am comfortable in that space. I do think investors and entrepreneurs have very different skill sets. I love being with entrepreneurs. I don't know if I have the stomach to be one myself. Maybe, never say never. But candidly, I haven't had an idea that I thought was worthy of pursuing just yet. I also have 3 kids, and you talk about those mortgages and student loans and all that jazz. But no, I have not launched one, not yet. Someday, knock on wood.
Krish, if you want to unmute and ask your question.
Yeah, so with the current rise in cryptocurrency, is it better to get funding from borrowing crypto than pitching to investors and venture capitalists?
Oh boy. So I mean, I don't know if you watched the news today. Cryptocurrency not doing so hot as of this morning. So I need to caveat everything I say right now with like, I am not a crypto expert. You probably know a lot more about it than I do. But I am leery of most cryptocurrencies, these, the ICUs that were really popular a couple of years ago. Mostly I'm leery because there's a lot of like fraud involved, and it's like hard to know. It's like really hard to tell the difference between something that is like genuinely value add and real and something that is not. And like, I'm not in the business of speculating, and I do feel like there's a lot of speculation going on in the world of cryptocurrencies. That said, clearly many cryptos like add a lot of value, like they do real things. So I don't mean to suggest either that they're all ridiculous. That's not what I mean at all. Now, as for like, offering tokens in exchange for cash to like get your business off the ground, I don't love it. I don't love it for a few reasons. One, I don't love it because like valuations of these companies have been insane, like absolutely astronomical. And like, while that's great for the founder right now raising money, it becomes really, really hard later on to exit profitably. Like, if I've got nothing but like some code written and I raise a bunch of, money through tokens that, value my company at $100 million, it's gonna be really hard to actually like deliver on that. I don't like it because of our initial comment earlier that, a real venture investor offers a whole lot more than just cash. It's their network, their advice. Like, They should be someone that can really help make your company better. And you don't get that with coin offerings. It's just really frothy and messy. So I am leery. And that might just be like old stogie me, and like I'm about to get railroaded by a big change in the way the market. But I don't think so. So we'll see. But yeah, Rish, I don't know. Maybe I should turn the microphone over to you to like expound why these offerings will change the world.
I myself don't know the answer. Thank you very much, Professor.
Yeah, of course.
If anyone has any other questions, unmute yourself or type in the chat. Abby, you can go.
I was curious, are you more likely to invest in an entrepreneur who has proven themselves before, or someone who this is their first idea?
Yeah, great question. So the unfortunate answer to that question is I think almost every venture investor, all things being equal, will invest in an entrepreneur that's been there, done that. It's just one thing that like helps de-risk the company a little bit. Now that said, like that's a hard game to play. An entrepreneur that has had those successes usually has the pick of the litter with which investor they're going to go after. And so there is plenty of space and plenty of money for first-time founders to raise it. And a good idea with a good market trumps a good team most of the time. And so, it's just a tough battle first-time founders will have to face, but certainly one that's conquerable. Yeah, I mean, investors are looking to de-risk their investment in every way they possibly can. And one way to do that is to invest in founders that have been successful before. It is an imperfect measure, though, of success, the probability of success. It's also one way investors are really biased. Like they look for pattern recognition and they want to do the same thing over and over and over again. It doesn't work out very well all the time. I know, female founders have suffered tremendously. Investors of color have suffered tremendously because of these pattern recognitions and the like old networks and been there, done that. So I do think the investor world is changing. It hasn't fully changed yet. But like short of wholesale change, like recognizing the challenges that you face and like addressing them head on is a great way to overcome the biases inherent in the networks and the challenges of being a first-time founder.
I guess another kind of like follow-up is, how do you feel about entrepreneurs who have had failed companies before, who have like done this before, but they haven't worked? Are you more or less likely to invest in them?
So that's a great question. And the answer, Abby, entirely depends on why the founder failed. So if the founder failed because he or she was screwing around and like was cavalier about spending money and was a poor manager, no, I would never invest in that person again. If they failed because they were too early to market or a product market fit just didn't turn out right and, kind of reasons beyond their control, then I'd be excited to invest in that person because they've learned a lot of lessons. Like there's a lot of lessons that come from failure. And so if I have the choice of investing between someone who failed, but for good reason versus someone who's never done this before, I'll take the experience. Again, all things being equal, I'll take that experience every time. So it totally depends on why they failed. But if the reason is good, then I wouldn't hesitate to invest in that person again.
Any other questions? Rish, you can go.
Yeah. So now, when you appeal to investor or VC firm, do you recommend offering them equity or royalty for the funding?
So venture investors want equity every time. Yeah. So we're trading cash for ownership. That's the business. Now that said, like when you go pitch these investors, like you don't need to be talking equity and deal terms in a first meeting, maybe not even in a second or third meeting. Like you're trying to convert them to your vision of the world that you're trying to fix. I would focus on the problem you're solving, how you're solving it, why it's a big opportunity, and why you got the right team long before I started talking about deal terms. I mean, personally, when I see like a deal terms slide in a deck from a founder, like we're way too early for this. Like that's not something we need to talk about yet. I mean, it will come up eventually if everybody likes each other, and you want to be in the right ballpark, but that's not the first thing I think most investors care to hear about.
Thank you very much.
Of course.
I think we'll let you go now because it's been an hour. But thanks a lot for all the valuable insight and taking up time, Professor.
Yeah, it's my pleasure. I hope it was helpful. Remember, I'm just one person. You should talk to lots of investors. They might have very different perspectives than I do. I am not the, the sole source of truth on this one. You should go listen to lots of people, and maybe the truth, I don't know, somewhere in the middle. But yeah, I appreciate the time and the chance to chat.
Thank you.